Good afternoon, everyone. Welcome to the Tyler Area Chamber of Commerce 37th Annual Economic Outlook with Dr. Ray Perryman. I want to thank everyone for joining us this afternoon, especially our sponsors who you've seen scrolling across the screen. We couldn't do these things without you. I also want to acknowledge the Tyler ISD and their TV studio located here at the CTC. It's a wonderful place. We're so grateful to have that facility for us. So this afternoon, we're fortunate to have Dr. Ray Perryman, who's going to share some of his thoughts with us, and then we're going to move to a Q&A. And I want to remind everyone who is on that you can submit your questions via the chat function, so we can hopefully have those through our Q&A and get those answered for you from Dr. Perryman. So we're always welcome and grateful to have Dr. Perryman. And for those of you who may not know him, I'm going to give a short bio because there's quite a bit of accomplishments that he's done throughout his career. So, Dr. Perryman, he's president and CEO of the Perryman Group, an economic research and analyst firm based out of Waco, Texas. His firm has served over 2,500 clients, including 2/3 of the Global 25, over half of the Fortune 100, the 12 largest technology firms in the world, 10 U.S. cabinet departments, the 9 largest firms in the U.S., and the 6 largest energy companies operating in the U.S., and the 5 largest U.S. banking institutions. Dr. Perryman, he has been named the most dynamic economic researcher in the U.S. by Global Business Insights. He's received the Chairman's Award for Lifetime Achievement in Economic Development from the International Economic Development Council. He is selected for the Go Global Award from the International Trade Council as Outstanding Global Economic Analyst for his work on trade, energy, the environment, and other international issues. He dedicates a significant portion of his time pro bono, work aimed to helping solve pressing social problems such as hunger, indigent health care, poverty, and child maltreatment. So it is my pleasure today to welcome Dr. Ray Perryman. Dr. Perryman?
Well, thank you very much. It's a pleasure to be here. Obviously, I wish we could all be together over at Green Acres like we normally are. I've been doing this for 37 years, and this is the most unusual year by far. And it's a pleasure to be with you, and hopefully next year we can all be together in person again. This has been a strange year for everyone. I know you've all had challenges. You've all had probably some good things and some bad things take place over the course of the year, and some things you had to deal with. It's been an especially tough year, I would say, for my spouse, Lorraine. Because most years I'm on the road about 300 days. This year I've been home about 300 days, and that's a very different environment. And a lot of things we've often said the secret to being married to me is we were married 30 years and together for 3 weeks, and that's obviously changed a lot this year. And one day I was somewhat on her nerves, and I said to her, I said, well, you know, honey, I'm kind of like bad tasting medicine. I'm just better in small doses. And she thought about it a minute, and she said, well, not really, because at some point, bad tasting medicine makes you feel better, and you haven't gotten there yet. So that's kind of been what my year has been like. But I know you've all faced challenges, and it's been a difficult year for all of us. And I want to try to spend a few minutes today giving you some perspective on the year, on where we've been, on where I think we're going. I will say this is the most uncertain time we've been in, certainly in my career, which spans more than 40 years. And I've studied the history of the country a lot longer than that, and I think we're probably at one of the most uncertain times we've faced. And so let me just kind of walk you through some of this stuff as best I can, and then at the end I'll leave some time for some questions as well. I understand the handout we normally provide has been provided in electronic format, and you can retrieve that. I'll talk about some of that as I go through here today, but I'm going to try to focus on some bigger picture issues as well. First thing I would point out is obviously this one is atypical. Those of you who have heard me before have heard me say on many occasions that normally when we have recessions now, it's not because the economy runs out of steam. It's because either some big force happens from the outside, or we do something kind of stupid on the inside. That is a mortgage bubble, or a .com bubble, or a syndication bubble, or whatever the case may be. This one was obviously a force from the outside, but very different than most situations. I guess if there's any good news in this from an economic perspective, it's been that the economy was not broken when this started. We were in the 11th year of an economic recovery. It was the longest in history. And so there was nothing to fix. I mean, every other time there's been a major recession during the course since my career kind of got going, I've been on some kind of federal task force to try to deal with some kind of issue, to try to get some kind of solutions. We didn't have to do that this time because there wasn't anything really broken in the economy. This is an economic crisis caused by a health crisis. But what that means is, and I think it's been hard for people to kind of realize this as we've moved along here, we can't really solve the economic crisis without dealing with the health crisis. And so that's what's before us right now. Trying to look at places to kind of see, well, what's happened in the past, what can we learn from, is there anything else we can do, which is also a way I try to analyze situations. I'm kind of an amateur student of history going back a long way where the economy is concerned. And the closest thing we've seen is the 1918 Spanish flu, and there's been a lot of talk about that along the way. And it was a much worse epidemic from just the perspective of the disease than what we've seen this time. But the parallels don't really stack up the way you would like for them to. You'd like to say, what did we do then, so let's do the same thing now, or how did we handle it then, what went wrong, what went right. The world was so different a century ago for us that we can't really talk about that. The Federal Reserve, for example, who's done a lot this time around, the Federal Reserve was only 5 years old. We'd gone from the 1830s, back in the battle between Nicholas Biddle and Andrew Jackson, up until 1913 without a central bank. We created the Federal Reserve in 1913, so it was just getting established and getting its sea legs. It didn't have any policy in its portfolio at that time, so we didn't really have monetary policy as much of a factor. On the fiscal policy side, we just didn't know what to do back then. Since that time, primarily in the 1930s, a lot of good research has been done to tell us how we can use policy effectively. We didn't have that back then. And of course, we were not a major world power back then. And so for all of those reasons, this is just not a comparable enough situation to help us. But we can kind of see what's happened, how we've been affected, and what things might look like going forward. The first thing I would point out in terms of the effects of this, the first thing we noticed in this country before the virus became a big issue here and was in other parts of the world, the first thing we noticed was supply chain disruptions. Because we buy a lot of parts for virtually everything we make here. We buy parts from other parts of the world, primarily China. And consequently, when China couldn't ship the parts, our inventories depleted. Our firms were having to shut down or cut back long before the virus was here. And we would have probably had a mild recession in this country even if the virus had never reached our shores, which of course was not practical. But even if that had happened, just because of how much we disrupted the global supply chain when goods from China couldn't be here, both consumer goods and particularly inputs to the things we produce here. So that was one thing that immediately hit us. The second thing that hit us pretty hard, particularly here in Texas, was one of the very early impacts around the world was a big drop in the demand for oil. And obviously that's a very big industry in the United States, particularly here in Texas and here in East Texas. And literally the demand dropped 30% in 35 days in the entire world. And that started creating some economic effects before the virus really came here in a big way. Then as the virus started coming on our shores and a few cases started appearing and they started being spread around the country, that's when we started to see things shut down and begin to see the things we experienced back in March and April. Probably the watershed moment for the entire country, the thing that got everyone's attention and said this thing is real, happened right here in Texas. It was when they canceled South by Southwest. Because literally Austin, Texas went from expecting 500,000 people in 3 days to expecting no one in 3 days. And that let people know it was real. Shortly after that, the major sports leagues began to realign their situations and the NCAA and others. And that's when we began to say this is going to be with us, and it's a pretty big deal. So that was kind of how it started. And then when it finally hit us in March and April, the thing that made this different from things we've seen in the past is how far and how fast we fell. We've never fallen this fast before and this far before. To give you an example, to kind of give you a little perspective on it, the Great Recession back in 2008, 2009, which was by far the worst thing this country had seen since the Great Depression, we lost 9.4 million jobs in the United States, almost 10 million, 9.4 million jobs in the United States over a period of 14 months. With this one, we lost 22.5 million jobs in 2 months. So we lost over twice as many jobs in 1/7 the time. I mean, we had never seen anything remotely like that before. The initial claims for unemployment is one of the indicators that people pay attention to now. They didn't pay much attention before. That's a fancy way of saying layoffs, because it's people who file for unemployment the first time, and that's usually someone who's been laid off. The highest number we had ever seen in the history of the country, back in the Great Recession, was 695,000. We saw 6.9 million one week in this situation. We're now 40 weeks into this thing, and we're still not getting back to anything close to the highest number that we'd ever seen before. We're still in the 800,000 range every week. So we're really seeing a very, very different type of situation than we've ever seen before in terms of its magnitude and the speed with which it happened. The GDP drop in a single quarter, we'd never seen anything remotely like that before. We destroyed 10% of what it took us 250 years to build in one quarter, and then started the comeback. And once the comeback started, you heard a lot of people saying, this is going to be a V-shaped recovery. That was particularly among the political class. Everybody was talking about, we're going to come back from this very quickly. It's going to be a V-shaped recovery. It never had the chance to be a V-shaped recovery. We don't have the mechanisms to come back that fast. It's been a pretty strong recovery. You could call it a pretty solid check mark or a swoosh, if some people call it, that sort of thing. But it certainly wasn't a V. We lost 22.5 thousand jobs in 2 months. We're now 7 months past that, and we've only gotten back a little over half of those jobs. So we're coming back. I mean, that's remarkable what we've done, but we still have a long way to go. At first, we did come back pretty quickly, and that was to be expected. Obviously, if you shut down your restaurant and lay everybody off, and then you reopen it at 25 or 50% capacity, you rehire some of those folks. So there's a lot of low-hanging fruit out there early on. The other thing we did early on was we passed the CARES Act, and it wasn't perfect by any means. There's some things it had in it shouldn't have. There's some things it didn't have it should have. It wasn't administered well. Some checks went out to dead people and the kind of things that happen when you try to do something like this in Washington. But nonetheless, it got some money in the hands of small businesses, key industries that were hurting, and individuals who were unemployed or suffering income losses. It got some money in their hands early on. And that really helped us because you keep in mind the structure wasn't broken. I'll come back to this over and over again. So if you keep the structure together, then you can recover pretty quickly once you have the health crisis under control. And so that helped a lot. The Federal Reserve was very aggressive in putting money into the economy, buying mortgage securities, buying government securities, buying commercial paper from corporations just to keep liquidity in the economy. They even bought some of the paycheck protection loans, the PPP loans, from the banks, just so the banks would have liquidity to make other types of loans. So the Federal Reserve did a lot to make sure the financial system stayed secure. Now, all of this stuff is going to increase the deficit, and we're going to have to deal with that down the road. There's no question about it. But right now, the situation is we can't worry about that. We have bigger problems. I've been, as those of you who've heard me over the years know, I have been critical of the federal government for the size of the debt and the deficits for many, many years. And the fact that we exploded the deficit during 10 years of economic expansion is a bad thing. The fact that we're using those resources now to keep this structure together is an essential thing. And I'll have a little bit more to say about that as we go along. But anyway, we did a lot of things right. We had some low-hanging fruit. So the economy started coming back pretty briskly, and then the growth started slowing. Now, some of that you would expect to happen because, again, the low-hanging fruit came back pretty quickly as people were able to reopen their businesses. But part of it was because the virus just didn't go away. And, in fact, it started coming back. We're in the middle of another surge right now. And every time that happens, a few more people have to shut down their businesses. A few more people have to cut back their businesses. More people are just nervous about spending money or nervous about getting out and doing things. And so that takes hold. So we've had a kind of a bumpy recovery. The first few months is getting the jobs back. I mentioned we've gotten back over half of them. We got back 2.7, then 4.8 million, really good, strong months. Then it was about 1 million for 2 or 3 months, then about 600,000, then back to between 200 and 300,000 again. And the reason for that, part of it was the low-hanging fruit, but a lot of it was as the virus got worse, the economy could not grow as fast. And then part of it was the simple fact that the stimulus money kind of ran out, and a lot of people who had been depending on it weren't getting it anymore. The paycheck loans only went for 2 months. That put small business under pressure. So there are a lot of things going on. And where do we end up with all this? What kind of is the economic outlook and that sort of thing, which I usually spend a little more time talking about, but I do want to mention it here. Right now, as I mentioned, the U.S. economy went down by 22 million jobs. By the end of the year, we think year over year, 2020 over 2019, will be down about 8 million jobs. So again, getting back a good chunk of them, almost 2/3, but not quite all of them. Texas, similar situation. We were down by 1.3 million jobs as of April. We're probably going to be year over year down around 540,000 or so, something like that. So again, we made back a good chunk of it, but not all of it. Tyler area, very similar. From peak to trough, down about 10,000 jobs. Probably in the year over year, down about 3,000 jobs. So actually doing a little bit better than the country and the state in terms of the speed of the comeback here, but still suffering a fairly significant loss as a result of this. We get most of that back in 2021, probably get back to where we were in early 2022, something like that, pretty much across the board. Our 5-year forecast for the area, which again is what we focus on in the report, they're kind of unusual this year because for this year, 2020 is the base year. And so consequently, a lot of the growth rates are a little higher than usual because we're starting from such a low base, and part of that's making up the loss. But nonetheless, we're seeing growth rates in the U.S. In terms of output about 3.8%, Texas about 4.4%, and this area around 6%. A lot of the strength in this area is going to be some of the comeback in the oil and gas sector. But again, we're starting from a fairly low place, and so you have to keep that in mind. But nonetheless, the last several years, Tyler's outperformed the nation and the state to some extent. We think that pattern is likely to continue because of a lot of factors that I'll mention as we go along here. But as we look to the future, the critical things we're going to have to focus on is the degree of uncertainty. The more uncertainty we have, the slower the recovery is going to be, because a natural human reaction to uncertainty is to do nothing. And so, and that's what we would tend to do. The other one's going to be the virus itself. What's the pattern going forward? We have the vaccines now. We have better therapeutics. We know more about the virus. And so we're likely to see, most people say by summer or so, some reasonable determination of what a new normal will be and ability to come back from this. And so hopefully we don't have much longer to go before we get to some semblance of some strength, some of that underlying strength coming back. But whether it's May or June or July or August, we simply don't know at this point in time. It's going to depend on how well we can deliver the vaccine, how well it's received, how effective it is, and just a lot of things that we can't know at this moment. And the other one's going to be what we do in terms of future stimulus packages, because even though we've done quite a bit, there's still a lot of people who are suffering. And remember at the beginning, what I said was if we keep the structure together, we can come back very quickly. We got ourselves, by waiting this long for this recent one we did, we got ourselves kind of in a way of almost breaking the structure. That is, a lot of small businesses were not able to sustain themselves. A lot of individuals were facing imminent foreclosure or eviction or that sort of thing, or were food insecure. A lot of hardship happened in the interim, and the difficulty with that is you can't recoup those things very quickly once you get past it. And it's not a fault of the businesses. I mean, if you take a typical small business that's very, very well run, it's been run for decades, it's been profitable, they've done a good job, they've been frugal, they've done everything they should do, and you take away half the revenue for 6 or 8 months, it's a very difficult situation. And that's what a lot of people have found themselves in. So hopefully as we move forward, we'll begin to see more of things done to kind of help us just keep that structure together until we can get past this. And then I think we'll see a pretty rapid and robust growth, and that's what our numbers reflect. I want to spend a few minutes talking about some of the industries that have been most affected and how they're likely to change in the future, because there's a number of them out there that are likely to see some fairly significant changes. Some of those we're already seeing. In some cases, we don't know what the change will look like in the future because it's going to depend on the new technologies that are developed as a result of this. But obviously, retailing is changing. We went through a period of probably the last 15, 20 years where every year the percentage of retail sales that was online went up a little bit every year as online kind of became a more important part of the way we shop. More people got confidence in it. The systems got better. This year we put that on steroids because suddenly people had no choice, and even people that didn't want to shop online had to shop online, and some of them liked it. And so you're probably going to see an acceleration of that. But by the same token, a lot of people want to see and feel and touch things and talk to people about them and be out there among the crowds and shopping. And the stores are going to make the kind of moves they need to make to encourage people to do both to shop on their websites and shop in person. And we've already seen a lot of the redesign of the old traditional malls into the outdoor walking malls and those kinds of things. We're likely to see more and more of that to kind of improve the consumer experience. So retailing is definitely going to change in some fairly important ways, and I think you will see the online piece accelerate a little more than it did before, but you'll also see the traditional retailers participating in that piece a little more than they've done before. So that's one thing that we know about. Real estate's going to be very interesting. Obviously, a lot of people are working from home now, and I know my office has been closed since March, with some people coming up optionally to work, but basically closed, and a lot of others have been. We've all kind of learned to do things on Zoom or some way, like I'm talking to you today. But and I think we've accelerated that. There will be more of that in the future than there has been in the past. But by the same token, there's real advantages to being in a room together talking to people and bouncing ideas off each other in a way that you really can't do that efficiently in an online environment. There's real advantages to being in person. I mean, one of the things I enjoy most when I come here every year is all the people and talking to people before and after and seeing old friends and talking to new friends. I miss that, and I know many of you miss that type of thing as well, and we want to get back to some of that. So I think what you'll see in the office environment is probably on a typical day there will be fewer people in offices than there were before, but each one of those people will probably require more square footage than they did before. So you got those two things kind of competing against each other to kind of figure out how things turn out. We're going to have to redesign a lot of office space, because what's happened over the last 20 years or more. When I first started building our big set of models 40 years ago, it was pretty standard, operating very little bit from industry to industry, but you hired a new office worker, you needed 300 square feet in additional space on average. Now that number is about 150 square feet, because we have simply become more efficient at using office space. Now I think we're going to have to distance those offices, have more enclosed offices, fewer of the big open areas, that type of thing. Things are going to change in terms of how we design offices, and that's going to create the need for more space even with fewer workers. So you're going to have those two things competing against each other. That's going to be a big shift. Transportation and hospitality is obviously going to change. People want to travel. People want to see the things that we saw before. We want to be with our families, but there are probably going to be different ways that evolves. So there's going to be a lot of industries that change. One I want to focus on for a moment here that I think is very important, and particularly here in the Tyler area, and one of the reasons I'm here today, and that's economic development. Economic development is going to change a lot going forward, and that change is going to come from several directions. First of all, with our corporate clients, and it was mentioned at the beginning, we have a lot of them. One of the big things we're seeing is kind of a universal theme among them right now is what they're calling supply chain diversification. What they mean by that is buying stuff from more than one vendor, and basically having more of their inputs produced in the United States. For a long time now, there's been a trend of kind of go with the lowest bidder, get one supplier, and kind of stick with them, and then try to manage your supply chain very tightly and make your short-term numbers look as good as you can and that sort of thing. Well, when that short-term supplier, that single supplier is all of a sudden not available to you, you quickly figure out that you want to have, in addition to that, some resiliency, some staying power. And the way you get that is you have multiple sources of inputs. You don't buy everything from the lowest bidder, so to speak. And with that comes opportunities for a lot of companies, a lot of industries to come back on shore. And I think another thing that's happened with the pandemic, a lot of people really didn't realize just how much of our key medical equipment and supplies was produced elsewhere. And when we started having some shortages of those things, was recognized there's some real value to producing some of that here in the United States. So there's going to be a lot of new opportunities in economic development, a lot of new firms locating, new firms starting and developing the United States to fill out the supply chain and provide more resiliency. That's going to be an opportunity. The challenge is going to be, that comes with that, the competition for those new sites is going to be more intense than ever. It's already extremely intense. I mean, when there's a major location up for grabs, we see the publicity about it all the time. There's massive competition among areas to get those locations. We've gotten more than our share of them here in Texas, fortunately, but it's always an intense competition. It's going to be even more intense now because every region of the country and every country in the world has basically been kicked in the teeth economically over the past year. This virus didn't care what state you were in. It didn't care who you voted for. It didn't care about any of that. And so everybody was hit very hard, so it's going to be a real challenge. Everybody's going to be trying to come back and compete very aggressively. But the important thing, and I think really important here for the Tyler area, is the nature of the competition is going to change. Workforce is still going to be the dominant factor, and you obviously have some good resources in that regard, some good training opportunities here, and that sort of thing. But other things that were always on the list somewhere are going to be much higher on the list now. The quality of life, the livability of a community, that's become very important. The healthcare system, and obviously you have a great one here, and you're growing your resources all the time. But basically now people want to know if something comes up, our people can be taken care of and their families can be taken care of. The education systems, broadband access. Can we function in a remote world if we're suddenly called upon to do that for a period of time? The parameters of the world have changed, and livability is becoming very important. Before we ever had the pandemic, over the last 5 or 6 years, there's been this trend. The acronym is ESG, standing for Environmental and Social Governance. And the idea behind it was you don't just look for ways to maximize your immediate short-term profits, but you look at the long-term situation to maximize your profits. And what that means is you look at the quality of the community, because you want your workers to stay there and be happy there and raise their families there. You look at the school systems, you look at the health systems and those kinds of things. This is going to become even more important, and livability is going to be more important. And again, this region with the beauty and the lakes and all the amenities that you have here really has a big advantage on that area as well. So I think a lot of those kind of things are going to coalesce in a way that benefits this area pretty significantly. And so I think that's one other thing that you can look for going forward in terms of the economy and how we evolve and how we develop over and above just the projections that we make about the sheer numbers. I think you're going to see that. The other thing I want to talk about for a couple of minutes is all the big things that drive the economy and what's happening with those. The one I've been asked the most about lately, and not surprisingly, some of you may ask me some of it about it today, particularly given what happened yesterday, but it's the election. What impact the election is going to have on the economy. And the answer may surprise you, but in all probability, the answer is very little. It's very rare. You have to go back almost a century to find a time when an election significantly altered the economic course of this country. Presidents don't have the power to fundamentally alter the economy. And in order to implement an agenda that might alter it, you need three things. You need the presidency, you need the House, and you need the Senate with 60 votes. And neither party had a remote chance of getting that as this went forward. We ended up with basically a tied Senate in which the Democrats break the tie, a Democratic House by a small margin, and a Democratic president. That's not enough to implement a broad wholesale agenda that makes a lot of big changes in things. It's really not. And then even within that, there's going to be challenges, because if you look at if you look at the current Democratic Senate as of yesterday or day before yesterday, when we have 50 Republicans, 50 Democrats, and then the vice president breaking the tie, when you look at that composition, that doesn't mean you automatically have 50 votes or 51 votes for anything anybody on the Democratic side wants to do, because you have very conservative Democrats like Joe Manchin from West Virginia, and very liberal Democrats like Senator Sanders from Vermont. Those two folks, there's a wide gap in what they can agree on. There's probably a wider gap between them than there is between Senator Manchin, who's a Democrat, and say Senator Cornyn, who's a Republican. And so what we're going to find now is the two sides are going to have to work together in a way they haven't really done recently, and hopefully out of that will come some positive legislation that can help the economy. But again, historically we've done studies, other people have done studies, and what they all show is it just really doesn't matter that much. Historically, the Democrats have had a little bit higher growth rate during Democratic administrations than Republicans. It's been statistically significant. That is, when you control for other factors, it is something that has mattered, but it's a very, very small amount that mattered, and even that may be from other policies from the previous administration. So you can't really tell. But basically, if you stop and think about it, the Johnson era was an era of strong growth. The Clinton era was an era of strong growth. The Obama era was an era of strong growth. So there's been some Democrats with some pretty good runs over the past 40 years or so. And so when you analyze it, that's basically what you find to be the case. But very rarely, there's absolutely no evidence that it's going to move the needle a great deal, and so that's not it. So what does drive an economy? If you look out 25, 30, 40 years in the future beyond this pandemic, what drives economies? And it's a few things, and they're very, very important. One of them is demographics. What's happening with your population in terms of their age levels, their education levels, their productivity levels, those kinds of things. Demographics play a huge role in long-term economic growth. Another one is the whole trade patterns, cost structures, and things, infrastructure in various parts of the world, because that determines how goods move around, who has an advantage and who doesn't. And the other big one is technology, and how technology evolves and changes the way we do things and that sort of thing. And that one, frankly, if anything, is probably going to be accelerated right now. So the bottom line is, if you look at those are the three things. They drive over 90% of global economic growth all the time. Just no matter what else is going on that causes it to wiggle up and down, the underlying trends are driven by those three things. Demographics have not materially changed at all because of this pandemic. The cost and trade patterns of the world really haven't changed much. They'll change a little bit. As I say, I think we'll have more stuff produced here in some industries and that sort of thing, but they're not going to make huge wholesale changes. Technology may change, but if it changes, it's going to accelerate. Because what we have done now is we have sent out to the markets a signal that says we need help with healthcare. We need help with protecting ourselves. We need help with travel. We need help with shopping. There are a lot of needs that need to be met. If you think about all the improvements in how we've gotten through airports since 9/11 and other types of security since 9/11, the reason for that was 9/11 sent a signal to the market, we need you smart people to figure out ways to improve our security. And the market did that. Now the market is getting huge signals about a number of other things, and the technologies will respond to that. And we're already seeing a lot of that begin to happen. So basically, to the extent they've changed, they've accelerated a little bit. They haven't gotten worse. And as we've tried to do some 25, 30-year forecasting over the past couple of months here, and we all know that that's an imprecise process at best. But when I look at the numbers that I'm doing now compared to the numbers I did a year ago, they're awfully similar. Now, some of the industries that the growth is in has shifted a little bit, but as far as the bottom line, where you end up in terms of GDP, employment, and those kinds of things, basically they're about the same, because we really haven't changed fundamentally what the size of the workforce is going to be or what the productivity patterns of the workforce is going to be. Those are the things that drive economies. And so this has been a terrible year, a difficult year. No one has escaped it completely in terms of the hardships that it's brought about, but it hasn't altered those fundamental things that drive the entire world economy. I want to try to close this part of it out with a couple of other thoughts, and then leave some time for you to ask questions and talk about anything that you'd like to talk about. And don't feel restricted to the things that I've said here. If you want to talk about something else in the economy, I'll do my best to respond to it. As you can imagine, this year I couldn't count the number of task forces and meetings and that sort of thing I've done remotely, of course, but we're very, very involved in a lot of things going on around the economy right now. But the thing I want to leave you with, which I think is very important, is while we're in the middle of this thing, don't start extrapolating this into the future and take it too seriously in that sense, because we get over things. We always have. There's a long tradition of that type of thing, and things we adapt, we innovate, we create. That's what we do, and we move beyond things fairly quickly. Let me just give you a few examples here to illustrate that. There was a economist, actually was a preacher, back in the early 1800s, who was one of the original so-called classical economists, and a friend of some of the guys in Parliament who did some writing in economics at the time. But he was basically a preacher. But he came up, his name was Thomas Robert Malthus, and he came up with an idea, and some of you have heard of Malthusian theory before, but what he said was, from his observations, it looked like the population was going to grow geometrically, very, very rapidly, while the food supply was going to grow arithmetically, like on a linear trend, not as rapidly as the population, so therefore we're all going to starve, basically, was the conclusion that he reached. And that never remotely came close to coming true, because number one, we figured out ways for the population not to grow exponentially, and number two, we figured out ways to increase the food supply dramatically. I mean, we produce more food on less land with fewer workers today than at any point in history. It's been a technological revolution that's been ongoing for over a century. And so we adapt, we adjust, we make these things happen. Another more recent example, one that's right here in Texas about 30 years ago. We'd been through the terrible oil bust and real estate bust and all those and the too much office space and that sort of thing. And the Austin paper reported in 1990 that Austin had a 25-year supply of office space. That we wouldn't need any more commercial development in Austin, Texas for 25 years. That was in 1990. So by that theory, we wouldn't have built anything in Austin between 1990 and 2015. I think we all know the world didn't work out that way. But more importantly, to illustrate what I'm saying here, in 1993, when the studies came out of the real estate markets in the country, guess what the hottest real estate market in the country was? It was Austin, Texas. 3 years after they said we're not going to need anything for 25 years, they were the hottest market going. And again, the point is being we overcome these things. We adapt, we adjust. Final example I'll give you. I mentioned earlier that we can't learn a lot from the 1918 flu, but there are some things we can learn from it. And as I mentioned, it was much worse in terms of relative harm than this one was. We had about 100 million people in the country back then, and 30 million of them were infected. If you apply that standard today, we'd have to have over 100 million infections for it to be as bad. We had 600,000 people die. And again, if you blow that up to today's population, you'd have to have about 2 million people die for it to be as bad. So it was much worse as a pandemic than what this one has been. And we didn't have the policy options that we have now. We weren't the type of advanced economy we are today, any of that. Nonetheless, the next 10 years were one of the fastest growing decades in the history of the country, now commonly known as the Roaring Twenties. I would suggest to you that, again, we have to keep the structure together, and hopefully we will. But we are in the process of getting the virus under control. Once we solve the health crisis here, we're right on the cusp of what could very well be another Roaring Twenties. With that, I thank you very much. I'll stop the formal part of this, and I will move over, and we'll have some question and answer. And again, I'll be happy to talk about anything that any of you would like to chat about to the best of my ability. I thank you very much for being with us under these difficult circumstances. I thank the school district for making these excellent facilities available to us, and I hope to be back next year in the excellent facilities over at the church, so that we can have a get together where we can all be in one place. Thank you very much.
All right. Well, thank you, Dr. Perryman. And as you said, historically, we've been able to have this where we have a gathering and we're able to network, and we're grateful for those things. At this time, I can imagine everybody who's sitting around their desk or their office or home are giving you a stand-up ovation and for such a great presentation. So thank you very much. And I miss those times. They will come again like you discussed. So I'm grateful for that. Looking forward to that again. But as we sit here, I want to again, thank all of the sponsors that we've had to allow us to continue to provide these type of educational events from the Chamber to the members. And I didn't introduce myself. I'm Roy Martinez. I'm the chair for the Chamber this year. Grateful to be here, humbled to be here, and so thankful to have somebody like Dr. Perryman here. As we've gone through, we've received some questions. I will remind others that you can still submit questions via the chat function on the webinar. So please do so as they come in. You will also have the document that Dr. Perryman talked about. You should have it in your inbox if you've registered for this event. So that's great information to have. So we're going to jump into some questions now, Dr. Perryman. All right? And
absolutely.
Thank you for the information. And we'll start kind of broad here. Some of the questions have swirled around the idea of there's been so much stimulus poured into the economy, given what we've gone through.
Right.
Where do you see the outlook for when it comes to taxes, the dollar, and just inflation overall? What do we see?
Well, there's obviously a day of reckoning for all of this, and we can't avoid that. Basically, as I've said, normally if we were seeing this much deficit spending, I'd be railing against it. I was railing against the tax cut when it happened because we couldn't possibly make up the deficit since we didn't. Every budget they passed in the last 10 years during a period of economic growth, but we're in a different situation now. I mentioned in the speech that back in the 1930s was when we figured out a lot of the policy for economic development and moving forward and stimulating economies. And at that point in time in the Great Depression, one of the more prominent economists was approached, and people said, well, you know, why are we doing this stimulus? You know, because it was basically the intellectual basis for Roosevelt's New Deal. And he said, you know, in the long run, the markets will take care of all this. And he just looked at him and said, that's entirely true. In the long run, we're all dead. And that's the situation we find ourselves in right now. This is such a dramatic situation. This is the time you want to make use of those tools. Now, what does that mean down the road? I suspect for quite a while we're going to have a fairly lax monetary policy. The Fed's pretty much told us for the next couple of years they're not going to do much to raise interest rates or anything like that. Over time, this will put inflationary pressure on the economy. We raised our inflation forecast a little bit this time around, but not a great deal. And the reason is there's all kinds of other forces out there that are pushing prices down at the same time. Think about what you paid for some type of technology 5 years ago and what you pay for it today. I mean, the consumer price index for technology is about 0.7 since 2012. Prices have fallen 30%. And so, you know, we have a lot of industries like that where you have prices falling. Global competition keeps a lid on prices as well. There's constant push for efficiency in industries. We've seen it in oil and gas. We've seen it in other places. And so yes, there will be some inflation to come from this. And obviously that's something that we'll have to deal with. We will see some impact on the dollar. We put a lot more dollars out there. But keep in mind, at least as a short-term matter, people talk about the dollar going up and down like it's something good or bad about it. It's just a market for currency like any other market. And when the dollar is cheaper, that also means U.S. goods are cheaper in the marketplace. And so that's not always a bad thing to have that going on. So yes, there will be some reckoning for this. There's no question about it. There will be inflationary pressures we have to deal with. But number one, I think we can deal with them. And number two, you know, this was not one of those situations where you could walk in and say good choice, good choice, good choice, bad choice, or anything like that. It was take the least bad choice. And the least bad choice was keep the structure together. Don't let us fall apart. Don't tear down the airline industry. Don't tear down some core things. Don't tear down our small business sector. Don't eviscerate families, and then deal with the other problems later.
I would very much agree. There is going to be a reckoning. We'll all
no
come
question.
around
Absolutely.
all the time. So kind of on the tails of that, it's cyclical economics, and one of the questions comes in. It says we know that the energy market has always proven to have a cycle and a cyclical nature to it. That being said, where would you say we are in that cycle, and what are the things that might factors that might push it one way or the other at this point?
Well, the energy industry is very interesting. We had this situation this year, obviously, that got a lot of attention where the price of oil went negative one day. Yeah. And that was because basically, as I mentioned in the speech, the demand for oil dropped almost 30 million barrels in about 35 days. I mean, we've never seen anything remotely like that. At the same time, Russia and the OPEC countries were fighting with each other, and they were threatening to increase production. So the markets were getting very nervous, and the prices were in the teens. But they finally made a deal, as they usually do, and we cut our production some, and Mexico cut theirs a little bit, and we finally got to a deal where we took the production down 12 or 13 million barrels a day. But what that meant was demand went down 30 million, supply went down 13. So you're still got to have a place to put the oil every day because you're producing a lot more than you're consuming. And at first we filled up the tanks, and then we filled up the tankers, and then we filled up the salt domes, and finally we got to that point where one of those days when the contracts end, which means whoever owns it that day. Oil trades all the time, but on a certain day when the contracts settle, whoever owns it that day takes possession. And they were coming up on this contract date, and there was no place to put it. And so people were literally paying people to take the oil off their hands so they wouldn't have to store it. And that happened for a day. But now we see oil back with Saudi Arabia's announcement this week. Oil's back a little over 50 this week. So there's clearly a cycle. It's a volatile market. I would describe it more as volatile than cyclical. It's hard to find a cycle in there, but you sure find a heck of a lot of volatility. We have reduced cost of oil dramatically through the technologies, how we've improved hydraulic fracturing and things like that. We've improved all of that dramatically. And consequently, where oil needed to be $75 a barrel to be profitable 8 years ago, it needs to be about $45 now. And so we're already in the cycle where the oil industry becomes profitable. Now we're going through a lot of consolidation. A lot of deck chairs are being rearranged. People with capital are buying out people who don't have capital and staying power. But the oil will ultimately be needed because global demand for petroleum is going to grow in the future. I mentioned to the leadership Tyler class in a different context this morning, the one law of economics there may be, and I've been around this a long time, and I think probably a city ordinance is as close as we ever get. We don't have the kind of laws like physics has, but the one I think, if we do have one, what it is when something has to happen, it will. And here's the bottom line about oil, because you hear a lot of talk about different types of energy and all those kind of things, and we need all of those. But the bottom line is, if you look at the emerging countries of the world, the ones that are just entering their industrial revolution, and how much they're producing in terms of manufactured goods and that sort of thing, and how much oil they're consuming, how much energy they're consuming, and you look at that 25, 30 years from today, we're going to need twice as much energy in the world as we need today, as we have today. Now, we're going to get some of that from renewables, and we should. We'll probably reinvigorate the nuclear industry and get some there. We're going to improve storage through hydrogen systems, through the new batteries that are being developed. We're going to do those kinds of things. And just for good measure, let's throw in a black swan, like the iPhone that came along a few years ago. Let's just throw in something that's never happened before that creates a 10 or 15% growth in the use of energy efficiency or something. Throw in something like that. We don't even know what it is yet. Even if all of that happens, 30 years from today, 60% of the energy in the world is going to come from hydrocarbons at least, maybe 70. Now, that's going to come in the middle of a climate crisis. So we're going to have to figure out ways to burn energy and reduce its carbon footprint with petroleum products. But we will do that because the market's sent out huge incentives to do it. There's billions of dollars being invested in doing it right now. So the bottom line is we are going to need this oil going forward in the world in order to sustain itself. And that rule of economics, whenever something has to happen, it will. So there will be demand. I think there may be some shifting between oil and natural gas because of some of the developments that are taking place with electric cars and the way we generate electricity and that type of thing. But nonetheless, we're going to be using these hydrocarbons for decades to come. So they are going to have a viable place. Now, they will ebb and flow, not so much in cycles, but in fits and starts with all kinds of things. Whatever happens with OPEC, on a given meeting is going to move the market some. You find things like that. There's all kinds of things that move the market around day to day, but fundamentally, oil is going to be with us for a long time. It's going to be a very, very important part of the Texas economy and the East Texas economy.
Well, very good, and that's one of the components that we have here in the East Texas market, and it impacts everyone. So
absolutely, and if I could add just a little bit to that, people get confused about it sometimes. But a lot of the reason why the growth rate is so high here in East Texas in output is the growth in energy over the next 5 years, and again, starting from a low base. So I mean, a lot of that's playing catch up. But nonetheless, sometimes one thing, and this is a little bit inside baseball, but I think it's worth thinking about. Energy doesn't drive a lot of jobs. It drives a lot of output. Because if you think about it, once you get a well drilled, I mean, it just kind of sits there and prints money for a while after that with fairly low upkeep. And same thing with refineries. I mean, you put the oil in a refinery, 3 people can run a refinery now for a shift that produces a whole lot of refined product. So it generates millions of dollars of value added for every worker, whereas your typical worker may generate $50,000, $75,000 of value added. They generate millions. So 3% of the Texas employment base is energy, and 15% of the Texas economy is energy. So what you find is it's not a source of huge number of jobs, but it is a lot of what drives your output growth.
Well, along those lines, and how things have changed for output, for example, what in the case of the shift that we're seeing, what are some of those types of industries, and you alluded to in your speech there, that there's some upside coming out of this economic shift?
Well, I think there's going to be a number of them. One, obviously, is going to be health and bioscience. And again, you've done a very good job of establishing this area as a center for that. My friend who recently retired, Tom Mullins, who I usually, I've picked on him throughout his entire career, but since he's retired, maybe I'll pick on him some more. No, I won't. But he did an excellent job, and a lot of other people here in helping to build that base here in Tyler. You have a great new guy that I've known for 20 years, and Scott, who's come in to pick up that mantle and move forward. Biotech is going to be a growth industry. There's no question. Your medical school is going to be a huge help in that, and all the new medical resources that are being developed here and those kind of things. There's going to be technologies, and again, we don't know exactly what they're going to be yet, but there's going to be technologies that are going to create growth opportunities to figure out how to let us shop and figure out how to let us travel and those kind of things. Again, we've kind of told the market that we need those things. And there'll be a lot of people trying to develop those things, and that'll create some new opportunities as well. Logistics is going to be a growth industry, and again, that's one where you're well positioned here. Transportation logistics, you already have some of that in a nice mix of resources to generate more of it. But as we've seen this year, as the economy has done so badly, the financial markets haven't done that badly, primarily because of the growth in tech stocks and logistics stocks, because we've had to figure out, more and more ways to deliver more and more things in a more timely way under different conditions and that sort of thing. And all that leads to innovation. So this situation will create a lot of growth opportunities, particularly in technology-oriented industries.
Very good, very good. Well, we're looking forward to position ourselves for that so we can continue to capitalize. To lead into that, you mentioned the medical side and the med school that we have coming. It's a phenomenal thing. But from your perspective, what are the positive things we can put in place to make this a great impact on our economy, to have something like the med school?
Well, a lot of it already is here. I mean, you have some great medical resources here already, and there's been a lot of effort in growing those and expanding those and that sort of thing. I think so. So obviously, part of it's continuing to do what you're doing, take advantage of those synergies. Obviously, it's anticipated this medical school. We did a lot of work on this, as some of you know, and it's anticipated this medical school will supply a lot of the healthcare workforce for the entire region over time. And I think that's something to have that ready, available pipeline is going to be very important.